first half of 2025 has been marked by an exceptionally tough market environment, one of the most challenging in the history of RHI Magnesita. We faced continuous pressure from weak industrial demand and a highly competitive pricing environment with pressure from China exporters and local players fighting for market shares in India, China, East Asia and META regions, in lower value and in commoditized segments. Margins declined and our financial performance was much below expectations. However, we have responded swiftly with structural measures to restore profitability. A targeted pricing initiative, sharp focus on cost efficiency, and portfolio shifts towards more resilient higher margin segments. The strong integration of Resco alongside a recovering order book, especially in non-ferrous metals, sets the stage for a materially stronger performance in the second half. Safety remains our highest priority, without exception. Our total recordable injury rate increased slightly in the first half, which reflects many one-time activities, structural changes, which are all designed to improve our safety culture. We are continuing to invest in safety transformation, both in systems and in behavior. With expert partners, we are strengthening leadership, accountability, and infrastructure across all of our operations to build a safer working environment. I'm also proud of the progress of our Help Fund, launched to financially support people affected by serious workplace incidents. This initiative reflects the values we stand for: care, responsibility, and solidarity.
In the first half, our revenue declined 3% to 1.7 billion. Adjusted EBITA came in at 141 million, with a margin of 8.4%, down from 11% last year. That's 35% of full-year analyst expectations, and in line with the revised guidance we gave in our Q1s. Importantly, we achieved strong cash conversion despite inventory build-up ahead of a stronger second half. Net debt rose to 1.6 billion following the Resco acquisition, lifting leverage to 3.1 times. We anticipate a reduction in leverage by year-end as earnings recover and strong cash generation continues.
Our industrial division saw volume growth in India, China, and the US. But this was offset by significantly lower activity in the glass segment and delayed non-ferrous metals projects. In steel, volumes were stable with growth from the Resco acquisition, though the base business declined slightly year over year. The integration of Resco is progressing well and is strengthening our local manufacturing footprint in North America. Operational excellence continues to guide our actions, improving customer service, reliability, and cost control. We are implementing targeted management action to strengthen our margin profile and support a recovery in the second half. We expect up to 120 million euros uplift in adjusted EBITA from deferred high-margin non-ferrous metals projects now scheduled for H2, a modest recovery in global steel output, and rebounding regional demand in META, India, China, and East Asia.
We have also taken action internally, with measures set to deliver up to 60 million. Our price increase program is already 70% contracted and expected to add 30 million in EBITA. SG&A efficiency efforts are underway and will contribute another 10 million. In addition, recent plant closures will deliver 10 million in cost savings. All in all, we now expect full-year adjusted EBITA of 370 to 390 million, with an average margin of 10.5 to 11%. These aren't just plans, these are actions already in motion.
We continue to see long-term value creation through M&A. The 390 million euro acquisition of Resco completed in the first quarter. It's a significant milestone and it expands our capabilities in the US market. In June, we agreed a new recycling joint venture with BPI in the US, aligned with our ambition to lead in circular economy solutions also in this region. These transactions underscore our discipline in selecting opportunities that complement our business model and enhance our customer offering.
Sustainability is at the heart of our long-term vision and daily operations. In the first half, we made solid progress, reducing emissions and advancing recycling initiatives. We are partnering globally to pilot breakthrough technologies like carbon remineralization and supporting customers on their decarbonization journey, including 5 major green steel contracts this year. Our new recycling joint venture in the United States and the expansion of Morocco in Europe strengthen our closed-loop model. As demand grows for responsible, low-carbon solutions, we are positioning ourselves as the partner of choice for future-focused industries.
The global market environment remains complex. We are seeing structural changes in Western demand, continuous pricing pressure, and regional volatility. But we also see growth opportunities, rebounding in India, Middle East, Turkey, and Africa, and across key materials like copper, aluminium, and glass. We are adapting with our agility, optimizing our footprint, building internal cost efficiencies, strengthening our customer base, and investing where we see long-term value. Yes, H1 was below our expectations, but the decisive measures we've taken are already settling the stage for recovery. And the fundamentals of our strategy, cost discipline, operational strength, and strategic growth remain strong. RHI Magnesita is built to perform through cycles. We are confident in our direction and in our ability to lead through tough times.